So they say that inflation is at 5.9%. I believe it's higher than that. And in response, the Reserve Bank increased interest rates to combat this inflation. As investors, what can we do to prevent the value of our money and assets from depreciating? Well, that's what we're talking about today. Hi, my name is Yolanda. I am a wealth advisor, and on this platform, I give you easy, actionable tips, content, and strategies that you can use to manage money well, to live abundantly, and build generational wealth. So, for consumers, inflation means higher prices on goods and on services, and the risk of losing the purchasing power if their income fails to keep up with this inflation. In economics, inflation is seen as a quantitative measure, one of quantity over quality, tracking the rate of change in prices of a standardized basket of goods. Inflation is defined as the increase in prices over time, and the rate of that increase is expressed as a percentage. Now, the Reserve Bank in South Africa aims for an inflationary range of 3 to 6%, and currently we're sitting at 5.9%. While inflation affects the economy and asset values can be unpredictable, history and economics offer certain rules of thumb. Inflation is most damaging to the value of fixed rate debt securities because it devalues interest rate payments as well as the repayments of the accrual principal. So if inflation rate exceeds the interest rate, lenders are in effect losing money after adjusting for inflation. So if you're a borrower and your inflation rate is higher than interest, you're getting paid to borrow. This is why investors sometimes focus on the real interest rate, which is derived by subtracting the inflation rate from the nominal interest rate. But what do I mean by this? It's called the Fisher equation, which is a concept in economics that describes the relationship between nominal and real interest rate under the effect of inflation. The equation states that nominal interest rate is equal to the sum of the real interest rate plus inflation. But first, I need you to hit the like button if you want to see more content like this. So when you borrow or lend, you do so in nominal rand terms. And if you take out a loan, the loan is denominated in rands, and your promised payments are denominated in rands. These rand flows must be corrected for inflation to calculate the repayment in real terms. A similar point holds if you're the lender. You need to calculate the interest rate you earn by correcting for inflation. So the Fisher equation provides the link between nominal and real interest rates. And to convert the nominal interest rates to real interest rates, we use the following formula. The real interest rate is equal to nominal interest rate minus inflation rate. So to find the real interest rate, we need to take the nominal interest rate and subtract the inflation rate. For example, if a loan has a 12% interest rate and the inflation rate is at 8%, then the real return on that loan is 4%. Let's say I lend you 100 Rand to be repaid in a year and charge you a 10% interest for my trouble, leaving me with a 10% profit. So in a year's time, you'll pay me back 110 Rand. And if inflation for that year was 10%, the money has lost its buying power. So you pay me the 110 Rand, but at the same time, the buying power of that money has been reduced. My profit is now zero, although you paid me an extra 10 Rand. Now apply this concept to your home loan. Your bond rate is 8.5%. Inflation is at 6%. Your real interest rate is 2.5%. You can either pay an extra 1,000 Rand into your bond and save 2.5% and shorten your repayment period, or you can invest into an investment that can give you a real rate of return of 10 to 15%, and that's up to you to find that kind of investment, or if you're keen on that sort of thing, reach out, I can help. Now, if your bond payment is 10,000 Rand a month for 20 years, today 10,000 Rand is 10,000 Rand in nominal terms. In 15 years, 10,000 Rand in relative terms, factoring for inflation, will be worth far less, meaning you'll be paying less in real terms, allowing you to redeploy your funds to work harder and smarter for you. Because if you can't make money in your sleep, you're going to work until you die. If you're getting value from this video, please subscribe to the channel. And if you're watching or listening on a podcast platform, subscribe to our show so you never miss out whenever we put out an episode. So going back to inflation, the assets that fare best under inflation are those assured of bringing in more cash or rising the value as inflation increases. Examples would include rental property, subject to periodic increases in rent, or a business that can increase prices to factor in inflation, like grocery stores. Property is a popular choice because it becomes a more useful and a more popular store of value amid inflation while generating increased rental income. So investors can buy property directly, or you can invest in property by buying real estate investment trusts, and we spoke more about it here. Property is also vulnerable to rising interest rates, and the financial crisis in the United States in 2008 showed us that. So when inflation picks up, investors often turn to tangible assets that are likely to increase in value. And for centuries, the leading haven has been gold, and to a lesser extent, other precious metals, causing prices to rise as inflation rises. So gold can be purchased directly. In South Africa, it's pretty easy. Kruger coins, American Eagles, Canadian Maples. Or you can invest indirectly via an ETF, for example, that owns gold. Investors can also get exposure to commodities by buying shares of the producers, like mining shares, for example. Also, crude prices offer very good inflationary shields because when crude prices increase, the price of fuel in the country increases. Transportation therefore increases, and that has a knock-on effect on everything else. Investing in bonds may seem counterintuitive as inflation is typically harmful to fixed rate debt. So with your home loan, if you're a borrower, the Fisher equation works to your advantage when inflation is high. When you invest in government bonds, you are the lender to the government. Say, for instance, that you invest 10,000 Rand into a 5-year government bond, and that bond gives you a 10% annual coupon rate. So coupon rate is interest rate. So each year, the government would pay you 10% of your 10,000 Rands as interest, and at the majority date, it would give you the 10,000 Rand back. So apply the Fisher equation to this. If the inflation rate is at 6% and the coupon rate is at 10%, your real rate of return is 4%. And for some people, a guaranteed 4% is great. For others, it's an absolute no-no. And from the 10,000 Rand you get back, the nominal value is 10,000 Rands, but the relative value on that is far less because of inflation. When you are a lender, variable interest rates are your friend. When you're a borrower, it's not. So you should be looking to fix your home loan to the lowest possible rate. Inflation-linked government bonds can also be seen as favorable because they offer the variable interest rate tied to inflation. So when CPI increases, so does the value of the inflation-linked bond. Not only does the base value increase, but since the interest is paid on the base value, the amount of interest payments rises when the base value increases. So there are tons of varieties of inflation-linked bonds that other governments outside South Africa offer as well. Shares, they also have a reasonable chance of keeping up with the pace of inflation, but when it comes to doing so, not all shares are created equal. For example, high dividend-paying shares tend to get hammered like fixed-rate bonds in inflationary times. Investors should focus on companies that can pass on their rising input costs to the consumer, like groceries, for example. The primary benefit of investing during inflation, of course, is to preserve your portfolio's value, not necessarily to lead to growth. This can also lead to diversification, which is always worth considering, and spreading the risk across a variety of holdings in a time-honored method of portfolio construction. And this is applicable to inflation-fighting strategies as well. So some of the pros of shielding for inflation: 1, you preserve the portfolio worth. 2, you diversify across multiple asset classes. And 3, you could possibly maintain your income's buying power if you're investing for income. Cons, you are increasing your risk exposure because you're chopping and changing so much, and you may be exposed to stuff that doesn't necessarily match up to your risk. 2, you divert from your long-term investment plans. You could be overweight in certain asset classes that you're not comfortable with. However, the inflation tail should never wag the investment dog. If you have a specific goal or timeline for your investment plan, don't swerve from them. As an example, don't weigh your portfolios too heavy with investment if it requires significant capital or time in the market. Also, don't buy long-term growth stocks if you need retirement income pretty soon. An obsession with inflation should never get you out of your risk tolerance comfort zone, and there are no guarantees. Traditional inflation hedges don't always work, and this could upset the traditional method of trying to shield for inflation. So if you want a policy review, a portfolio review on how you can shield for inflation, click the link down below. I'd love to chat to you one-on-one.